Dan Ives from Wedbush Securities has explained that investors are overlooking how much Tesla will benefit from the rapid advancement of autonomous driving and robotics technology. In a recent conversation with CNBC, he stressed that in his opinion, Tesla remains the most undervalued company positioned to gain from artificial intelligence. This is a strong statement given that he also covers Nvidia and Palantir, two of the most widely recognized players in the artificial intelligence space. His comments highlight that he believes Tesla's upside potential goes far beyond its current role as an electric car manufacturer. Ives predicts that Tesla could one day achieve a market capitalization of $3 trillion as physical artificial intelligence products begin to make up a significant portion of its revenue stream. This expectation suggests a potential gain of more than 115% from the company's current market value, which sits just under $1.4 trillion. While Ives is very optimistic, the broader group of analysts is not nearly as positive. The average target price for Tesla shares stands at $349, which would represent a decline of about 21% from the current trading price of $443. Analysts remain cautious because Tesla has been losing market share in major regions including China, Europe, and the United States. As of the end of June, Tesla accounted for 12% of all battery electric vehicle sales, a sharp decline from 18% during the same period last year. At the same time, Chinese carmaker BYD expanded its market share by 2 percentage points and became the worldwide leader in electric vehicle sales volume. Tesla's financial performance in the second quarter added to investor concerns. Vehicle deliveries were down 13%, a result of intensifying competition, but also a reflection of consumer hesitation that some attribute to Elon Musk's outspoken political activities. Revenue dropped by 12% to $22 billion, and adjusted net income fell by 23% to 40 cents per diluted share. These figures clearly underscored a difficult period for the company. Unfortunately, the outlook for the third quarter is also looking discouraging. In Europe, sales declined by 40% in July and 37% in August. In China, sales dropped by 12% in July and by 10% in August. Although the United States did see modest sales growth during those months, Tesla's domestic market share still slid to 38%. According to Reuters, this marked the first time Tesla's share fell below 40% in the United States since October of 2017. Even though Tesla currently generates the bulk of its revenue from electric car sales, the company is positioning itself to capitalize on far greater opportunities in the fields of autonomous ride-sharing and robotics. Elon Musk has stated that Tesla could eventually become the most valuable company in the world several times over, with the potential to reach a market value of $30 trillion if it successfully expands into physical artificial intelligence. Tesla has already taken steps in that direction. In June, the company rolled out its first autonomous ride-hailing service in Austin, Texas, and since then it has received regulatory approval to start testing services in Arizona and Nevada. At present, Alphabet's Waymo is still the leader in the robotaxi market, offering services to the public across 5 American cities. However, Musk insists that Tesla possesses key advantages that could allow it to eventually dominate the industry and capture more than 90% of the global market. The distinction between Tesla and Waymo comes down to the technology they use. Waymo depends on an expensive combination of sensors, such as LiDAR, radar, and cameras, to generate highly detailed city maps. These maps serve as a foundation for its autonomous vehicles. In contrast, Tesla relies exclusively on computer vision and does not rely on mapping cities in advance. This approach reduces costs and makes the system more scalable. Evidence of this advantage is already visible. In Austin, despite entering the robotaxi market 3 months later than Waymo, Tesla has managed to expand its coverage area to twice the size of its competitors. This suggests that Tesla's simplified and more scalable model could give it an important long-term edge. Beyond ride-hailing, Tesla is also building out its robotics business with the creation of a humanoid robot called Optimus. Elon Musk has claimed that this product could eventually account for 80% of Tesla's total value. Tesla plans to ramp up production next year and has set a long-term target of producing at least 1 million units annually within 5 years. If successful, these humanoid robots could transform entire industries by replacing human workers in repetitive, dangerous, or physically demanding jobs. The implications implications for the labor market would be immense, and Tesla believes it is well positioned to lead that transformation. The potential financial rewards in these sectors are staggering. Goldman Sachs has forecasted that ride-sharing revenue in the United States will reach $100 billion by the year 2030. Morgan Stanley has offered a far more aggressive estimate, placing the total market opportunity closer to $1 trillion. Meanwhile, Citigroup expects humanoid robot sales to generate $210 billion in annual revenue by the year 2035. Morgan Stanley once again provides a more ambitious outlook, suggesting that humanoid robot sales could hit $5 trillion by the year 2050. These projections reveal the enormous scale of the industries Tesla is aiming to disrupt. From a valuation perspective, Tesla is currently the third most expensive stock in the Standard & Poor's 500 index, trading at 178 times estimated earnings for 2026. While this valuation seems extremely high, many argue that it should not be taken at face value. This is because Tesla is no longer just an electric vehicle company. It is transitioning into a company focused on physical artificial intelligence, which means its potential future earnings growth could be significantly stronger than what today's numbers suggest. Investors who focus only on near-term earnings multiples may miss the bigger picture of Tesla's long-term strategy. For investors, the decision comes down to conviction. Those who doubt Tesla's ability to successfully pivot into autonomous ride-sharing and humanoid robots should avoid the stock entirely. On the other hand, risk-tolerant investors who are comfortable with the possibility of a 50% decline may see a unique opportunity. If Tesla succeeds in reshaping both mobility and labor markets, the long-term upside could be enormous. For these investors, now may be an appropriate time to consider taking at least a small position in the company, with the understanding that the journey will involve volatility and setbacks. Essentially, Tesla is facing mixed views from Wall Street, with Dan Ives from Wedbush Securities predicting the company could eventually reach a $3 trillion market value thanks to opportunities in autonomous driving, ride-sharing, and humanoid robots, while most analysts expect downside risk due to weakening sales and declining market share in China, Europe, and the United States. Tesla's second quarter saw deliveries drop by 13% and revenue fall by 12%, with further declines in Europe and China during the summer. Despite these struggles, Tesla is expanding into autonomous ride-hailing and robotics, with Elon Musk aiming for massive long-term growth that could reshape the mobility and labor markets, although the stock remains very expensive at 178 times estimated 2026 earnings. Investors without faith in Tesla's pivot should avoid the stock, but risk-tolerant investors who believe in Musk's vision may see this as a chance to buy early into future growth. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.